Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, folks, to another edition of All Things Financial. Again, I'm Jack Driscoll. I own Driscoll Insurance and Financial Services on South Park Road in Bethel Park, Pennsylvania. And what I like to do in these sessions are not as much educate you, which you'll get a lot of education out of these, but it's really to show you a lot of the areas in financial planning that you might be missing out on. So I want to try to help illustrate and expose you to many of the areas that might help you make more out of your money. What we've seen in the last couple weeks is a great deal of discussion and attention placed on market volatility. What's it doing to people's 401ks? What's it doing to the IRAs and the mutual fund world? Oh no, what are we going to do? Stocks can actually go down. And they go down a lot when they go down. So we run into a lot of discussion on market volatility. Should we get the question, move all our money out of the markets if we're close to retirement? What's this going to do to our retirement dreams? I've even seen articles written now over the past year that regulators are approving fixed annuities or income annuities in 401k plans for the purpose of trying to provide income that you can't outlive, trying to provide more secure outcomes from retirement planning vehicles such as 401ks, mutual funds, and things like that. So there's a great deal of discussion on this market volatility avoidance as being the single most or the most important area to focus on. And I'm here to help share with you. I don't think it is the most important thing or the only thing to be placing all of your attention on. When I look at retirement planning, I happen to see other areas maybe equally or more important or devastating if they're ignored to a retirement plan than even market volatility. So I wanted to share some of those other key components with you when you're doing retirement or pre-retirement planning or any form of planning with what to do with your money. You know, no matter what happens with market volatility, we get into retirement and let's say everything works well. There is a scenario of an illustration that you can request from almost every company you do business with called the sequence of returns. And what it deals with is what happens if you retire in a bad year with the same amount of money as someone that retires in a good year or in a good sequence of years in the markets versus a bad sequence of years in the markets. And it's called sequence of returns. So you can Google it and you'll see what I'm talking about. And they'll normally use a case of client A and client B if they retire at different points in time of the markets, how long that money may take until it runs out. So I wanted to share with you, there are different scenarios, even in the same type of portfolio investment mix. Well, with that, no matter what type planning you do, that's still dealing with market volatility as your primary concern. But none of those illustrations or type of planning evaluate other, what may be even more greater risks to your retirement portfolio. Let me give you an example. You get into retirement, you structure your income, your assets are adequate based on your calculations, your income is adequate based on your calculations, and you forget a critical component, a key component, which is possibly, we didn't think about what if my income dies when I die and my spouse loses that income from my pension and possibly the spouse loses income from Social Security also. So have we insured the income at all is the question. Or maybe, is there such a dependency on the income that my wife and I both need both of our incomes from Social Security and pensions, that we should have thought through the years of retirement, not to the year of retirement. That is a critical component in retirement planning, in my opinion. I'm a certified financial planner. We are trained to look outside the box and try to evaluate all areas and components that are common to financial planning, not just one. So we look at this component of income planning and we look at survivability, whether income will survive you or not. If you have assets that you're drawing income from, and if you die, that is not a critical component to whether the asset dies, because the asset still lives on, then your income might be quote unquote sustainable for anyone who else is dependent on your income, like a surviving spouse. But if your income is a pension income, for example, now we might have a problem. So I want to share some of those problems for those of you who have a pension income as a potential component in your retirement plan. If you do, a typical pension while you're still working is not accessible to you. It is available for you in retirement as long as the pension is still financially sound and feasible in retirement. So be careful, folks. We're seeing pensions under financial strain because the markets whipsaw the pension funds just as they do your own individual money. So we see pensions scampering on, we're projecting our income benefits for retirees on markets, average rates of return on our pension portfolios. And as it turns out, we're estimating, some pensions say, 8.5% annualized rates of return. You'll see recent articles saying pensions are being forced to reevaluate average rates of returns down lower, which means they will have to, these companies, possibly set aside more money on your behalf because the income or interest or earnings or growth projected is going to be less projected rates of return annually than originally hoped for. So if they thought they'd earn 8.5% and it now looks like they might only earn 6.5% or 7%, that means to hit your retirement goals that they've projected to you as an employee, they have to set aside more principal since the earnings might earn less. Well, here's what I want you to watch for. I want you to first go, for any of you who have a pension opportunity with your employer, I want you to go to the employer's plan, the pension plan, and I want you to request a pension retirement estimate. That is given a certain projected date of retirement. You go to the employer's plan and you say, I'd like a retirement pension benefit estimate based on so-and-so month in 2020. Many plans will give you a pension estimate. It's only an estimate, but it'll give you a guideline on how much monthly income they expect you will be eligible for. And then here's what I want you to do. While you're on the phone with them, after a long period of hold, I understand that, but while you're on hold with them, write down these questions. Number one, get the pension retirement estimate. Number two, I want you to ask them, do you have a beneficiary listed now on your pension? The reason I want you to ask that is, what if you die tomorrow in a car accident while you're still working? Don't have any pension survivor option listed. Don't have any beneficiary listed. That pension account that was allocated on your behalf might go up in smoke. You might find, however, that if you contact them in advance like I'm asking you to, and ask them to name a beneficiary, a spouse or children, name a primary beneficiary and a contingent if they allow it. Many pension plans don't. But if they do, then there may be someone on record to receive all or a portion of your pension should something happen to you prematurely. Now, folks, remember I said in the beginning of the show, market volatility is something that a lot of people are dwelling on. and ignoring some of these other issues. But by not following that advice I just gave you, you may in fact run the risk of losing 100% or all of a pension benefit that was being earmarked for you simply by not following those simple steps. So again, I reiterate, number one, call the pension, get a beneficiary or get a pension retirement estimate. Number two, ask if a beneficiary is named on the account. If not, put it on there now. Number three, ask what is the option if you die prior to retiring, prior to hitting retirement age. Is any of that pension vested? Vested means yours to keep, but again, it's usually only during lifetime. So what you do is you ask them, is it vested? If it is vested, you say, what happens to my account if I die before I retire, before I reach retirement age? Many times they'll say, well, the pension disappears. You need to ask why. And they might say, all pensions default to single life payout, and you're the single life. So if you die prematurely, there is no one else. Even if you have a beneficiary, if the survivorship option, and that's a key phrase for you, is single life only, it doesn't matter whether you have a beneficiary listed or not in many cases. So what I want you to do is ask next, can I establish a survivorship option on my pension if I die prematurely? And in many cases, they'll say, sure, you can do 5 years, 10 years, 15 years, survivor. So here's what I want you to listen to and write down. Whether you die prematurely or you now have retired from a pension, you will be given choices. If you if you ignore those choices, you'll normally be under the single life survivorship option, which means that pension will last as long as you do and die when you do. So if you only live 1 month after the pension retirement date, you get one check and then die. The pension dies with you if you're on a single life payout. What other options are available, you might ask? That's what you need to write down and ask your pension. The other options that are available might include a 5-year guaranteed payout as a minimum, a 10-year guaranteed payout as a minimum, a 15-year guaranteed payout as a minimum. So now what you're trying to protect yourself for is that some portion of your pension is at least paid out over a 5, 10, or 15-year period, even if you don't make it. Doesn't that make more sense? Well, you have to look at the numbers, folks. To take any of those survivorship options means you will reduce your pension check. So it means sacrificing a reduced check. You might have been entitled to $900 a month. Now will only be entitled to $800 a month, but it's guaranteed for 15 years, let's say. Well, there's another option. If you have a named beneficiary on the account, especially if it's a spouse, that is the spousal survivorship option. And many times they'll allow up to 50 or even 100% of whatever your pension benefit, but again, albeit a reduced pension benefit, but whatever your pension benefit is, to last for both you and your spouse's lives as long as either of you or both of you shall live. So that might knock a $900 a month pension down to $750. But is that sacrifice worth it? If it lasts for both you and your wife for as long as either of you live, that's a question worth consideration. So you need to ask now before you even retire. You don't wait till you retire and say, yes, I'll have to make those decisions by the time I retire. Because if you, the employee, die prior to retirement age, poof, there goes your pension. And what if the option of 100% survivorship opportunity did exist, but you didn't elect it, thinking, well, I won't die before I retire, I have plenty of time. What if you in fact named your spouse and already elected the 100% survivorship option, then died prematurely prior to retirement? You would have possibly protected your pension for the life of your spouse even before you retired. Now, your other question should be, and write these down, should be, if I elect that option now and I'm only 55 or 58 years old and I don't plan on retiring until I'm 65 or 66, what if I then choose a different option? Am I allowed to change that option up till any time up to retirement? And most pensions say yes. It is not an irrevocable option, but it is once you retire. So up to the age or point where you retire, you can change the option. But at the point of retirement, once you select it, that's your last point. Doesn't that make sense? Select a retirement option, a pension survivability option, get your beneficiaries on there, and then anytime up through and to the retirement date, you can change it and then make a final option at the point of retirement. Doesn't that make sense? A lot of people miss out on that. So they're thinking market volatility is their biggest risk. I'm thinking not protecting your pension might be your biggest risk. That's an all or nothing risk, I feel. Another one, and there are a lot of all or nothing risks in what I call financial planning or retirement planning. Another one is you do your income planning in retirement or for retirement. And then you die and your income dies. You could have insured the income. Maybe you should buy life insurance to protect the income. Maybe you shouldn't. But the point is you're never usually even looking into the issue until after you're retired. Oh no, what happens if my wife and I both need both our incomes and then I die and she loses Social Security income? You know from my prior shows, she doesn't lose all of this is Social Security income or even all of your Social Security income. She loses, in most cases, the smaller of the two checks. But that could still be huge, especially if you lose pension income in addition. So what you many times need to consider is, do we need to buy life insurance? Is there no better way to ensure survivor income than possibly buy life insurance to make sure to provide enough assets to continue income that will be lost should I die? And isn't that no different than the planning we do at age 30 and 40? Most of us were taught in our early years, you only need life insurance for age 30 or 40 until your mortgage is paid off and your kids are out of college. And after that, you'll no longer need life insurance. So what did the life insurance people tell us then to buy? Term. They told us buy 30-year term insurance or 20-year term insurance and invest the difference. Folks, look at your own portfolios. It didn't work in a lot of cases. They should have been advising through, not to, the years of retirement, but they didn't. They were too short-sighted. I myself was too short-sighted in many of those plans back then to realize what I realize now with retirees that I counseled back in the 30s and 40s and did not realize about the survivability of income being still dependent on each spouse's life. I missed it, folks. I missed in many cases that I should have done permanent life insurance back then while they were in their 30s and 40s, because we now need to buy life insurance for people in their 60s that had I been farsighted enough when I was in my 30s and 40s, helping clients in 30s and 40s plan for their income replacement needs. It wasn't only to the point of getting the house paid off. It wasn't only to getting the kids through college, but rather after those needs were gone, new needs sprouted up and replaced them that were still dependent on my income or my life. And I still need to now buy life insurance at age 60 that had I thought through, I would have bought whole life back then in my 20s and 30s and 40s, while I, number one, was healthy enough, and number two, young enough that the premiums were cheap enough that I could have afforded it and it would have helped build a cash value to help support my retirement rather than an expense to drain from my retirement assets. So that short-sightedness, for those of you in your 30s and 40s and 50s listening to this show or watching this show on Bethel Park Community TV, pay attention. stop and think. And it's much less expensive, where you may be insulating yourselves from some of these fears and turmoil of market volatility in your retirement years. You may have helped insulate yourself from having to be so devastated by some of these market volatility fears by shoring up the other areas in your financial lives. Here's another one. Think about it early enough. We did everything right. We figured everything right in your retirement planning. We figured your income planning. I didn't even get to tax planning yet. I'll probably get into that in another show. And we forgot about long-term health care planning. So now we've completely exposed you or your spouse, because by the time we realize long-term health care, nursing home type planning is of issue, you're already 65 or 70 years old before you even think about starting to talk about the issue. And by then you have such medical illnesses or conditions, we can't even get the insurance. So insurance as a viable option or solution, a preventative solution for wiping out your assets, is now off the table. Whereas if we had anticipated that, maybe at age 30 or 40 or 50, and thought far enough in advance to one of the biggest, greatest looming risks to retirement security that exists in today's world, having nothing to do with market risk, having everything to do with health risk, we waited too long. Through all the years you could have medically qualified, while you were in good health, and while your age would have allowed it to be very affordable, with a low enough premium that you could have still afforded it in retirement years. We waited too long to start talking about it or thinking about it. And now, even if we could afford the higher premiums at the older age, you can't medically qualify for it because we waited too long to have the discussion. So for those of you who are looking at this, I bring out this show as a community service. This isn't an advertisement show. This is an educational show, but to help educate and illustrate to you, not to learn how to rebuild the engine of the motor of the car, but to rather understand that without many of these preventative resources and dealing with a highly skilled technician, your car could break and you won't know why until it's too late. But if you know why in advance, what makes the car work, you don't have to know how to fix it, but you have to hire the right mechanics in advance to always help you maintain your car. That's what this show is. Hire the right mechanics to help maintain your total financial portfolio. The best way I knew of to illustrate that is to come out and help illustrate what are all the different areas that no one's even talked to you about that you find and learn in advance. If you take care of the precautionary methods and mechanisms that are in advance, you can have a finely tuned machine in finances like you can a mechanic and not wait for everything to break to then go in and get it fixed. That's a certified financial planner, folks. That is the process of what we call comprehensive financial planning, not just investment planning, a financial advisor, but rather trying to get someone to help you, guide you through all the phases of your life. All right, folks, we're out of time. I hope some of the things I bring up on this show pique your interest. If they do, feel free to contact us. I'll be happy to give you a free financial consultation. We're out of time again. We'll be back again next week. Thanks for tuning in to All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.